Tax loss harvesting sounds like one of those Wall Street terms designed to make you feel like you're winning at finance, but does it actually put more money in your pocket, or is it just a fancy way to lose money more efficiently? Let's pull back the curtain on a strategy that some swear by and others quietly question. Here's the core idea. You sell an investment that's down, lock in that loss on paper, and use it to offset gains elsewhere in your portfolio. Think of it like returning a bad purchase to get store credit. You didn't love the outcome, but at least you got something back. The math on the surface looks compelling. If you're in the 37% federal tax bracket and you harvest $10,000 in losses, you're potentially saving $3,700 in taxes that year. But here's the catch nobody leads with. You have to buy back into the market. And if the market rips higher while you're waiting out the 30-day wash sale rule, you just paid for discipline with opportunity cost. The 1990s gave us the first real wave of enthusiasm around this strategy, when robo-advisors didn't exist and wealthy investors were paying advisors specifically to do this work manually. Fast forward to 2023, and platforms like Betterment and Wealthfront are automating it daily, making it feel almost too easy, which historically is when we should all start asking harder questions. Here's the uncomfortable truth the brochures skip. Tax loss harvesting is a deferral strategy, not a free money strategy. You're kicking the tax bill down the road, lowering your cost basis, which means when you eventually sell the replacement asset at a gain, Uncle Sam will be waiting patiently with his hand out. Studies, including research from Vanguard and MIT Sloan, suggest that in ideal conditions, tax loss harvesting can add roughly 0.5 to 1.5% in after-tax alpha annually. But ideal conditions includes high volatility, high income brackets, and long holding periods. For someone in the 22% bracket with a stable, low volatility portfolio, the benefit shrinks to nearly rounding error. The irony is that the people who benefit most from this strategy are the people who need the tax help least high earners with large taxable accounts and significant capital gains exposure. If you're a middle-income investor with a 401k as your primary vehicle, harvesting losses in a taxable account is essentially optimizing the garnish while ignoring the entree. But let's not throw the baby out with the bathwater, because there are real scenarios where this tool earns its keep. If you're rebalancing anyway, if you have concentrated positions, or if you're transitioning between asset classes, harvesting losses along the way is essentially free efficiency. You were going to make those trades regardless. The behavioral trap is the real villain here. Investors harvest losses and then, emotionally rattled, fail to immediately reinvest in a correlated asset, sitting in cash during a recovery. One study found that investors who harvested losses but didn't reinvest promptly underperformed buy and hold investors by nearly 2% annually, which is a painful way to outsmart yourself. Historical cycles remind us that the best harvesting opportunities come in the worst market moments. 2008, 2020, the 2022 rate shock sell-off, precisely when most investors are too scared to act strategically. The lesson isn't to be brave, it's to have a pre-written plan so fear doesn't get a vote. The misconception worth killing right now is that tax loss harvesting means you're selling low and giving up. No, you're selling one position and immediately buying a similar one, maintaining market exposure while capturing the tax benefit. You're not exiting the game, you're changing jerseys and staying on the field. The practical framework is simple. Only harvest if the tax savings exceed transaction costs and tracking complexity. Only in taxable accounts, and always have your replacement security pre-identified before you sell. Process beats conviction every single time. Emotion is what turns a smart strategy into an expensive mistake. Position size and consistency matter more than perfectly timing your harvests, and a disciplined investor who harvests modest losses regularly will outperform the one waiting for the perfect big loss that may never come. Slow and steady optimization, compounded over 20 or 30 years, is where the real edge lives. At the end of the day, tax loss harvesting is a genuine tool, not a miracle, not a scam, and your job is to understand exactly when it works for your bracket, your timeline, and your temperament. Whether it adds a 0.5% or a full % annually, that's real money, and real money deserves a real strategy. If you're ready to put disciplined financial thinking to work across your broader wealth picture, whether that's real estate investing, home contracting projects, or finding the right lenders, check out our links in the description below.